Entrepreneurs and small business owners, financial mistakes can make or break your success. Today, I thought I'd dive into this topic, some major financial mistakes to avoid, and to do so, I'm calling on a top expert on this subject. Stay with me. I'm Pallen, a brand strategist. Welcome to my channel where I promise practical advice to build your brand. Today, let's talk about growing your business, and I often talk about marketing and branding on this channel, and actually that topic will come up related to a mistake that entrepreneurs often make, but I thought for this video, I'd take a step back with a wider lens and look at what we can be doing better to manage our money and grow our businesses. Now, I do not consider myself an expert on this topic, so I'm calling for backup in this case. Daryl Ching is one of the smartest people I know on this topic. He's the owner and founder of Vistance Capital. He provides accounting and CFO services to small businesses like you and me. Vistance Capital is sponsoring this video, but of all the interviews that I've done for this channel, this might be the one with the most actionable advice. I think you're gonna love it. Why is it that we only call our accountants when it's time to file tax?
Setting up financial statements for the purpose of investment, whether you're applying for a bank loan or you're looking to approach an investor for equity, is very different than just doing financials for tax purposes. A lot of small businesses do the bare minimum because they don't want to invest money into accounting. They'd rather invest money into sales and business development. So as a result, the financial statements suffer.
And what can that mean for you if your financial statements suffer? Well, it could jeopardize an investment when raising capital, when an investor is doing their due diligence, or trying to get approved for a bank loan. It can be a very embarrassing moment for you if your finances are not in order. So today's video is designed to help you avoid those situations. So let's jump right into it. Financial mistake number one to avoid: growing irresponsibly. And I'll explain. Every entrepreneur, everyone wants growth, but it isn't just growth that you want because on its own, that isn't guaranteed to be sustainable. A quick Google search and you will find lots of companies like this, some brands that you may have heard of like Zigna, Crumb's Bake Shop, Kind Snacks, and many others cited in this entrepreneur article, which I'll link to in the description below if you're curious. Here's how Daryl describes how to approach this the right way.
There is a way to grow responsibly so that you are set up for success. So if you think about a business, a lot of times when you're starting a business, it starts really almost like a house of cards where you don't have a strong foundation. You've just launched your product. You're putting the pieces together. You're putting structure in place. And I think a mistake that often is made is that entrepreneurs want to start launching other products before that structure is sound. So you're adding a roof when you still have a house of cards and you haven't built the foundation yet.
I actually love that analogy. That's great advice. Ensure the foundation is as sound as possible before launching your next product, which you need capital for.
What ends up happening is they end up taking resources from their existing core business and stretching them and stretching their people to try to do too many things. And actually it results in a burnout. And the worst case scenario when you try to grow too fast is not only do you fail on those new product lines, but you also destroy your core business.
And that's not good. Something you definitely want to avoid. How? Responsible growth through budgeting, analysis, a look at ROI, understanding if it's a revenue stream to pursue. Someone like Daryl is the right person to ask about this.
We love growth, but we love responsible growth.
Agreed. Let's keep going.
There is nothing more important than the people in the business.
This actually leads us into our next big mistake. Mistake number two, not having employees, the people in the business, in the right roles. If a business is going to succeed or fail, the number one determining factor is the people. According to Daryl, hiring the right people is one thing, putting them in the right place is really another thing entirely. Where do we see this happen within a business? Often, Daryl says he spots it all the time when employees are promoted to management. So how do you avoid this? Daryl has two very clear and concise action items for you.
Take the example of somebody who's really good at logistics and administration, and the next natural promotion is to management, where all of a sudden this person is now moving from administration to training, to managing vacation schedules, to doing performance reviews. And this person may not necessarily be very good at that, or nor maybe do they like doing this job. So you've turned a first-rate executor into a second-rate manager. You want to have the conversation of, is management something you are interested in? Do you have the right training for management? Or should you keep this person in an administration and create more of a specialized role for this individual so that they stick to their strengths?
Let's move on to our next mistake. Number three, not counting business expenses as such. Since many small businesses are set up as sole proprietors, they often mix business and personal expenses. And here's why that can get troublesome.
This can make things very confusing because you actually have to take time and effort to go through these bank statements and circle every expense that's a business and make sure you put these expenses into your financial statements. And a lot of people fail to do this. If you are using your own personal money to cover business expenses, that is money that the company owes back to you personally. So let's just say, for the sake of argument, you put up $50,000 of your own money into business expenses. That means that at any point in time, you can actually take $50,000 out of the bank account from your business back to your personal, tax-free.
According to Daryl, this avoids the necessity for you to have to pay yourself a salary and then paying payroll taxes on top of that. Obviously, you'll want to talk to someone like him about navigating this, but it all begins with being organized and counting business expenses as such. Someone who's savvy can also spot the difference between an expense and an asset, and it should be categorized as such. For example, purchasing a piece of paper, let's say, that's an expense, versus buying a $50,000 3D printer. That is an asset.
Without asking questions, a lot of times a bookkeeper will take that $50,000 and book it as an expense in 1 month, which is absolutely incorrect and makes it look like your company lost a lot of money when that's not true. You've invested into an asset, and there should be a $50,000 asset on your balance sheet.
I told you this is great stuff, and we've got more mistakes. Let's keep working our way through our list. Moving on to mistake number 4, not forecasting or knowing your margins on every single product that you sell. Okay, let's talk about this. This was an eye-opener for me because, admittedly, I did not know my margins on every single product that I have, but I'm improving that now thanks to Daryl. He said that it's common for business owners to know their top-line revenue, but not for single products and services. Here's why that's a mistake.
If you don't know these profit margins, it's very difficult to figure out where to go with your business. So let's just say you were to raise capital and you were to bring $1 million into your business. Well, should you invest in your e-commerce? Should you put more money into research and development on product A, or should you put it into product C? You really can't make any of these decisions if you don't understand your margins.
Your margins dictate where and how much you want to put into parts of your business. Knowledge is power, as they say. Also, forecasting. Daryl says a 1-year forecast is good, but a 2-year forecast is better.
Without a forecast, you can wander aimlessly and be in a position where a year goes by and you look at your results and you're mortified by your results, that you're not happy with where you've gone, but you weren't tracking month to month, so you weren't aware until much later. And at some point, it can be too late, especially if you have a limited cash flow budget.
Yikes. Hopefully this is prompting you to take proactive action on this stuff. Certainly has for me. Okay, one more major financial mistake to avoid, and this one might surprise you. Number 5, not investing enough in marketing. As a marketing and branding person, obviously I find this refreshing, especially coming from a fractional CFO or accountant. And while so many people might think marketing nowadays is easier because it's more accessible to the masses, social media, content creation versus TV, newspaper, radio, Daryl says that it's actually noisier and it's much more difficult to stand out.
If you're looking to attract the right audience, the skill set required is much higher today than it was 20 years ago, just because there are so many more sources out there.
Since it's more difficult to track the right people, you might consider hiring a professional marketer with experience that aligns with what you're wanting to accomplish. The other important consideration, the brand that you have and the brand that you're building.
So even as an accountant, and I stress the importance of this, and I go into a lot of businesses often telling them your marketing budget is not big enough. People are buying brands, not products. People think you make the best product and the audience will come. That's not necessarily true, because if you don't have a clear market strategy, no one will ever hear about it. It is absolutely vital to put money into branding and marketing and to make sure you have a clear, coherent go-to-market strategy, and make sure that you have that in your business plan before you launch any business.
Well, music to my ears. I want to round off this video with an explanation of what a fractional CFO like Daryl actually is and how someone like this can help you out.
A lot of companies cannot afford a full-time CFO. A good one is going to cost you north of $250,000 a year. But could they use a CFO for 1 or 2 days a week for maybe 10 hours a month to get some advice on how to spend their money, how to create a proper budget? Absolutely, they can. So we developed these fractional CFO services for small businesses and provided the hours they need to make important decisions.
Well said. Thank you, Daryl, for your experience and collaboration to make this video. If you are interested in speaking to Daryl, you can and you should. I'm going to put the link in the description below. He's incredibly wise at this stuff, and speaking to him immediately put me at ease and taught me a lot about what I need to know to grow my business the right way. Again, linking that in the description. What takeaway was most eye-opening for you today? Let me know in the comments below. Let's keep the conversation going on down there. I respond to those personally. If you enjoyed this video, give it a like. That helps other people discover these videos, which we work hard to create for you. And subscribe for more of my videos on branding, positioning, building, and promoting your brand. Next, I'm sharing a few videos I think you'll be interested in. I'm Phil Pallen. Thanks for watching. Those videos are coming up next.